Good morning and welcome to the CT UK High Income Trust PLC investor presentation. Throughout the recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time by the Q&A tab situated in the right-hand corner of your screen. Just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all the questions submitted today and publish responses where it is appropriate to do so. Before we begin, I'd like to submit the following poll. And I'd now like to hand you over to Peter Brown. Good morning to you, sir.
Good morning, and good morning, everyone. Welcome to our update. My name is Peter Brown. I'm part of the Columbia Threadneedle Investment Trust team. With me today, I have David Moss, who's the Managing Director of Columbia Threadneedle, and also the Lead Manager of the CT UK High Income Trust. Today, we'd like to run through a bit of the portfolio. David's been in charge for just over 12 months, so we'll just have to run through what's changed and the outlook for the UK. So, David, I'll start by a brief introduction to yourself and CTI and the organisation.
Okay, well, good morning, everyone. As Peter said, I'm David Moss. I'm the lead manager on the CT UK High Income Trust, and I've been for about a year now. Columbia Threadneedle is one of the world's largest global investors, so we have a very big resource to support us, and it's great to be part of such a leading investment management group.
Okay, and so we move on to the UK in general. I mean, people are saying it's cheap and it's good value and maybe an area of some reward for investors. But what are the opportunities now you see in the UK market?
Okay, I mean, I think you're right. It's the fact that the UK is good value has been talked about a lot, and that's whatever way you want to look at that. If you want to look at a company's profits, if you want to look at the cash flow that companies generate, if you want particularly important for us, the dividends that companies can pay. But any of these measures, the UK looks a much cheaper market than any other developed market globally. It's true that the UK economy has been weak. It's been talked about quite a lot now in the middle of an election campaign. And inflation, higher prices, has been an issue, again, across many countries, but they've remained perhaps more elevated in the UK. Although, interestingly, as we do this webinar today, we saw the news this morning that UK inflation has gone below 2% for the first time in quite a while. So one of my points here is that lead indicators of inflation are improving. So the signs that we look for to say as things are getting better, well, that's now come to fruition. Inflation is below 2%. So yes, that there have been some issues with the UK economy, but I guess my point and our point of view would be that that's no different to many other leading economies. And in fact, certainly compared to the Eurozone, where we know there are lots of issues as well, the UK looks like it's doing relatively well. So leading indicators are better. Employment's still robust. Wage growth is still robust. These things are coming down a bit now, but still relatively strong. So the economy looks okay. Inflation's coming down. There are lots of great companies in the United Kingdom, which is one of the things we think is really important to talk about. And we think we're not paying that much for them. So that to us looks really attractive for the UK, Peter.
Okay, so and then how are you? Well, let's have a quick introduction to the trust itself. I've put some brief details on the screen there. But how are you? How would you describe the trust and what can it offer investors?
So I think it's a fairly unique, and that word is used a lot. I know it's a fairly unique offering. So it's an equity trust. We only invest at this point in time, at least, in equities. It's called high income because it delivers high levels of income. So the net yield at the moment is nearly 6%. That's a very high level of income that we can provide for our shareholders. Total assets is 130 million, just under. So it's not the biggest trust, and that gives us some flexibility in what we can own. But it also means that we can deliver high income, but we believe that income can grow going forward. So that is actually, I think, really interesting because one can get high levels of income, high dividends at any point in time. But what we want is our shareholders to be able to own the trust and believe that income will grow over the long run. And we think that can happen. So it's fairly unique. So UK focused. The dividend is fully covered. What do we mean by that? We mean that all of the income, all of the dividends that the companies that we invest in pay, goes out to our shareholders, and we can cover all of that and all the costs associated with the fund. That's important because that's not always been the case in the last few years, particularly during COVID, when UK companies stopped paying dividends. We can invest up to 10% of the trust assets in companies outside of the UK. Now that's something which is different to many other investment trusts. And again, I use that word unique. I think that is unique. And why it's important is we talked earlier about the UK being a very attractively valued market. We can buy great companies at good prices. That's true. But one of the things we know we struggle a bit with in the United Kingdom in companies in the stock market, certainly the larger end, is growth. There aren't that many, for example, technology companies in the UK. By virtue of being able to invest up to 10% in Europe, we can invest in businesses that have attributes or exposure to areas that we cannot get access to in the UK. So we think that's something which helps us deliver long-term capital growth as well as income for our shareholders. I mean, that's really important. And again, something different about this trust.
Okay, and we'll come on to some of those stock examples in a minute, maybe. But just can you just run through briefly, because it is, again, it's a unique trust. There's the ordinary shares and there's a B class of shares. Just remind investors what the difference is between the two.
So both share classes have the same level of dividend. So the income that anyone as a shareholder will receive is the same amount. The difference is that the A class pay that income to you from the income that the trust gains from the shares we invested. So that counts as income. For the B shareholders, then actually that's paid as capital. So it counts as a capital return. So that may be attractive to different classes of investors.
And how has the portfolio changed in the last 12 months since you took the reins in July last year?
Yeah, I think that's quite important. We've done quite a lot. We'll talk a little bit about how the trust has performed in a moment. But performance was very good for some years and then not so good and was volatile. So we felt as we looked at the world in July last year, things had changed. We'd clearly gone past that COVID period. We look like we've emerged from the worst influences, particularly high energy prices, etc., of the issues in Ukraine. And therefore, we believe that we were back to what perhaps is a more normal environment. Interest rates were positive. We talked a bit about inflation earlier. We think that will come down, and interest rates will come down at some point, but they're not going back, we believe, to where they have been for post the financial crisis and during the COVID period. So the backdrop to which we are investing has changed fairly significantly, and that meant we needed to think about how we invest on behalf of our shareholders slightly differently. So one of the things we've done to start with, we reduced the number of non-dividend paying names. That might perhaps seem fairly obvious in a company that is trying to deliver high levels and growing levels of income, but these businesses can also deliver capital growth. And for many years, this is quite successful. We felt the time now was to actually drive the level of income higher. So that meant increased annual income. Importantly, the income that was derived by the trust from the shareholdings that we have was actually quite concentrated. A few names, a few companies accounted for quite a high proportion of that income. So we felt it was important to diversify the sources of income so we can pay our shareholders a higher level of dividends over time, but make it from a wider range of companies. Because as we've seen in the last years with COVID, Ukraine, we never know what's going to happen, what's going to come around the corner. So we felt it was important to be more diversified. So we've increased the dividend coverage and increased diversity of income. A couple of areas that previously the trust had not invested in to a large extent, or at least at all, would be things like the banks. And that made sense in the period post 2008 onwards. It was a really hard world for the banks. They didn't have much capital. Profits were difficult. Their profits were low. Obviously, they had some mis-selling issues for a number of years. But again, the world has changed. The change in interest rates dramatically changes both the bank's profitability, the profits they can make, but also how stable they are, because they're not just reliant on lending money to people. They can get money from other sources. The UK banks, and we mentioned NatWest and HSBC here, have very high dividend yields. So NatWest is over 5%, HSBC is nearly 7%. So this is a good way for us to gain income for our shareholders, but again, diversify. And in both cases, we believe these companies can grow these dividends going forward. So important. The next thing which is linked to the diversified source of income is tobacco. Tobacco was one of those areas where it formed a large part of the income that the trust generated. And while the tobacco companies have been very solid dividend payers a number of years, we know from looking at their financial statements, and I think we all know this ourselves, that the number of smokers is declining year on year. Either because people just don't smoke as much anymore, maybe they've changed their vapes, or merely because the tax is so high that it's become economically too difficult. Therefore, we talk about sustainable in many ways, but ultimately how sustainable are those dividends into the very long term? So we felt it made sense to reduce it. We still own tobacco stocks, but they're much smaller than they were. We sold smaller non-profitable investments. Again, these had and demonstrated high levels of growth during the COVID period, but that looks slightly more spurious now. So we sold the likes of ASOS, Delivery Hero, which is an Asian food delivery company, a bit like Just Eat, THG, another online business, and replace those what we believe are larger, profitable, and world-class businesses. In many of these cases, they don't pay high dividends. They do pay dividends, and they will grow into the future, and they will provide us the opportunity to provide much better capital growth for our investors. So SAP is a world leader in the fact the world dominates in its space, German software company. Sage, we perhaps know in the UK, as an accounting software company. They've broadened their offering much more now into a full software solutions for small and middle-sized businesses. ASMI is a semiconductor equipment company. It's absolutely unique in the world and very, very high growth. Again, I mentioned earlier, those sort of businesses don't exist in the UK, but we can access to them with the investment trust. And we also added dividend paying, good growth UK domestic businesses. We talked about the UK being attractively valued earlier, and that's definitely true in those businesses which are very UK based. So Dunelm, I suspect most people will know Dunelm. If you don't, it's a furnishings, a homewares retailer, and the biggest in their space, very well run, generates very strong cash flow and pays good and growing dividends. Taylor Wimpey, the house builder, difficult period for house builders in the last couple of years, but we remain in the UK structurally short of housing. We need to build more houses. We're hopeful that post-election there will be some release in the planning constraints that will help these businesses, but pays a very high dividend yield in the meantime. Now, perhaps the last one I'll mention of those is, because we might talk about Ibstock later, Supermarket Income REIT does what it says on the tin. They're a real estate investment trust. They own supermarkets and they lease them back, primarily to Tesco's and Sainsbury's. So very, very secure, very long-term income. The rents are linked to inflation, so protection for us, and it pays a very high dividend yield for us. All of that means that we believe we have a strongly performing portfolio and will demonstrate.
Hi, David, Peter. If I may just butt in there, I think we have just lost your audio. I don't know if you've changed something on the speaker there. Maybe you could unmute it. David, Peter. If I may just butt in there, I think we have. I'm just going to. Yeah, perfect. If you could just. I think you just unmuted it. If you could just do the same again there, Peter, that'd be great.
Can you hear us now?
Perfect. Can hear you clearly. Carry on.
Yeah,
Thank you very much.
Hi everyone. Apologies for that. We lost sound for a moment there. I was just summarising to say what we've delivered. We believe since the changes we've made the last 12 months are a strongly performing portfolio. We'll talk about that in a moment. Of really good quality companies that pay dividends, that we think can grow capital. Share prices will go up over time, and income. They pay a higher dividend to shareholders, and that's a reasonable change from 12 months ago, I think.
Okay, and we'll just move briefly on to performance, just for the people looking at the slides. Just running through the last maybe 6 to 12 months, the performance has generally come in what sectors, could you say?
It's come across a wide range of areas, and perhaps we'll talk about some of the individual stocks in a moment. I think what's important and interesting is it's come both from stocks we've held in the past and new stocks. But I think importantly, if you look at the slide here with the over the years, what you can see is that in previous years, performance has been very strong sometimes and weak in other periods. And the changes we've made have been, we hope to deliver stronger, less volatile performance. And we think you can see that both in year to date and in 2023, and the previous slide showed 1 year. So performance has been strong. Clearly, we need to keep delivering that, but we think we're well positioned to do so going forward.
Lovely. Okay. So if we look briefly at the portfolio, then you can see on the left-hand side the positives that have helped returns, but clearly there are also some negatives in the portfolio. If you want to run through a couple of examples there.
Yes, I mentioned this just now, and I think again what's important here is that both stocks the portfolio's owned for a while. So Cairn Homes, Irish house builder, Intermediate Capital, which is a private markets, private equity, private debt business. They've been in the portfolio for a long time, and actually they've delivered really strongly in the last 12 months. But equally, businesses we bought relatively recently, things like Smurfit Kappa, have been very strong. NatWest we talked about earlier as well. These are businesses haven't owned very long, but already made significant contributions to performance, and they delivered strong levels of income as well. But at the same token, Diageo, what the negative means there is that we don't own those shares. We don't own Diageo, and that's positioned relative to the FTSE All Share, which is all the UK companies and the position they have. So we don't own it, and by not owning, that's delivered positive performance. That was a share that the portfolio had owned for a number of years. We sold it. We didn't think the prospects were great, and nor was the income level. So we benefited both owning businesses, but also from the changes we've made in reducing businesses. On the negative side, some of those businesses have been owned for a long period of time, and we've now sold them because we think that actually they're not going to contribute going forward. Close Brothers would be an example there. By the token, Shell, I talked earlier about issues about the banks not being owned in the portfolio. Oil was another area that previously the portfolio, the trust had not owned. We believe that the world has changed there. The oil companies, and Shell in particular, have demonstrated that rather than when high oil prices come, they'll just spend it all. They actually will deliver returns and produce returns for shareholders rather than just to reinvest in ever more exotic projects. So we have a high level of dividends that's growing, and also very strong share buybacks. So Shell there, not owning it previously had hurt us, but actually we've now decided to own that stock going forward. So that demonstrates, I think, some of the changes that happened in the portfolio over the last 12 months and the impact that's had on performance.
Okay, and there's a reminder to viewers and listeners to submit some questions if you wish. We have had a question come in, which is quite appropriate. What are the main criteria you use when selling certain positions, like those you have mentioned? And if it's in a small cap sector, is liquidity an issue and then preclude you from finding new opportunities?
Liquidity can be an issue. One of the benefits of investing in an investment trust is that the shares on it are in existence. So there aren't lots of flows in and out all the time. So that can be an issue in unit trusts, for example. So we have less of an issue with liquidity. As I said, we would like to make this investment trust much bigger, but at the moment, it isn't the biggest. So we have some more flexibility. So liquidity is always something we think about, but it's not the biggest barrier. Clearly, we wouldn't be investing in very, very small companies, partly because they tend to be very volatile and not pay income. So that's that issue. In terms of criteria for selling, sometimes, and this is the nice time, they do incredibly well, and we don't have the same level of upside, or perhaps no upside anymore. So interesting enough, both Cairn Homes and Intermediate Capital are positions where we now have smaller positions than we had 12 months ago, because the shares have done incredibly well. While we still think there's upside, that's clearly less than it was before. And because the shares have been so strong, the dividend income, percentage-wise, that they pay out is lower than it was before. So we've recycled that capital to other things. Perhaps you use the example of Diageo. Diageo is a business which is a very large company, but very large company because it had done well for many, many years and made lots of acquisitions. It bought lots of other companies. When we look at prospects going forward, for those who don't know Diageo, it's the world's largest spirits company. So Smirnoff, they also own Guinness. They own tequila brands. Johnny Walker is the biggest whiskey brand. Spirits generally are struggling at the moment. Again, something that worked very well during COVID. These companies use the benefit of inflation to put prices up a lot, and they're now struggling because raw material costs, their costs are coming down. They cannot put prices up anymore because consumers are rebelling by not buying the products, and they're seeing very little volume. So it's a very difficult outlook from this point in time. So that's the sort of business we would sell. We think the business model is not working, or sometimes it's broken. And if there's no income to provide us in the meantime, that's another reason for selling a stock.
And again, it's similar on the portfolio and the positioning. Another question's come in. Do you feel the portfolio has now been repositioned, and therefore can we expect less turnover this year?
Yeah, absolutely. I think it's a really good question and a very fair point. Turnover has been high for 12 months, and it has been about repositioning. I would expect it to be a lot less going forward. I still think there'll be turnover. We will take advantages. The markets can be quite volatile. When that provides opportunities to buy good businesses with good levels of income, we will do that. So we will still have turnover. And I often think some managers say we have low turnover and that's its excuse not to do anything. If it's the right thing to buy or sell, we will do so. But absolutely, we believe the portfolio is in the right position now. Again, we talked earlier, the income, the dividend that we pay to shareholders now covered the income we receive. That's really important. And that level we think can grow going forward because we invest in the good companies. So we're in a much better position.
Lovely. And on positioning, then let's have a couple of examples of the stocks you own. We start with Intermediate Capital.
So we talked about Intermediate Capital a little bit earlier because it was one of the top contributors in performance last year. And it was really interesting. I talked about this probably 6 months ago when we last did a webinar. And at that time, the share price hadn't really moved very much. The difference now, it's performed very strongly for the last 6 months, but it's still, as we can see from the valuation on the slide, we still do not think this is an expensive company. If we look at the multiple that we're paying of the company's profits compared to the market, that's quite attractive. The dividend yield is lower than it was because the shares have been so strong, but still very attractive, and importantly, still growing into the future. But more than anything else, private markets. And private markets is where a business will invest in, unlike us, and we invest in shares that are listed in the stock market, they're private companies. They could be quite big, but they invest in private companies and the debt of private companies and infrastructure. That's what Intermediate Capital does. This is an area where investors generally want to have more exposure. Intermediate Capital is one of the leading businesses globally in this. And every time they raise money, they raise bigger funds than they ever did before. That means higher profits for them going forward, which means their ability to pay dividends out of share grows more into the future. And we think there's a lot more growth. So it's a great example of business, as I said, that can deliver returns and dividends now, and we can just hold it and watch them grow into the future.
And private equity is obviously an area that in the past has produced some really decent returns.
Very strong returns. It's had periods where it's been difficult as well. But we think the industry has learned from those periods. It now has much less debt, much better focus, and a much better structure to how they invest. And it's a very, should we say, hot area for investors as well.
Indeed. Okay, and moving on to a company that's a little bit different in every sense. It just remind the investors what Ibstock does and a brief reason why you own it.
So Ibstock is the UK's largest brick maker. So literally they make bricks. They make concrete products as well. We'll focus mainly here on bricks. And I talked earlier when referring to Taylor Wimpey that the UK, we are short of housing. We're not building enough houses for lots of reasons, which we don't have time to get into now, but we need to build more houses. Now, while there are more and more modern construction methods being developed all the time, bricks is still the predominant way that we use to build houses. It's embedded in planning. It has some very attractive practical applications. It can be weatherproof. It looks good. It works very well. Cement, for lots of reasons, it still makes sense. It's still the prominent way. We talked a bit about with short housing, and we talked that we were hopeful that post the election, we will see some change to planning because it's a key priority to increase the number of houses. With a house builder, obviously they tend to build, not exclusively, but tend to build houses for the private sector, houses for us to buy. We have to be cognizant, perhaps with a a Labour government, if that's what happens, which looks likely, there clearly will be a move to build more social housing, which is desperately needed. That's perhaps less attractive, or can be attractive, but perhaps less attractive for a traditional house builder. If you're a brick, you don't really care if you're on a private house, flats, or social housing. So for Ibstock, it's irrelevant what sort of house we build, as long as we build more houses. So we think Ibstock's very well placed for that. They've been investing in more efficient, lower CO2 capacity. In fact, I think they produced the world's first zero carbon brick recently by using renewable energy. So very efficient new plant. They have deliberately, while they've cut costs in a difficult period, deliberately not cut them back as far as they could, because they want to be ready for the recovery when it comes. So we think this is a business not very big, pays a good level of income now while we wait, has very strong potential. And a great example, those domestic businesses, partly because they're small, partly because they're domestic, that lots of investors don't appear interested in. We think it's a great business for the next probably 12 to 24 months at least.
Excellent. And a final example, possibly, SSE.
So SSE used to be called Scottish and Southern Energy. That was too big a mouthful, so they just called it SSE. So SSE, exactly, I struggled. SSE is one of the UK's largest electricity companies. They are unique in that they have both generation, so they make electricity if you want, and they have transmission and distribution assets. So they have the grid north of the border. They have transmission, which is the wires that connect to our homes in both north of the border and some in England as well. The beauty of SSE is those are very important assets as we move towards a carbon neutral environment. So electricity, as we know, has to grow. The other area has to grow, of course, is non-carbon generating power, solar, wind. SSE is one of the world's largest wind farm developers, particularly offshore North Sea. It's a very difficult environment. They are leading everyone in this area. So they have some of the world's biggest wind farms already operating in the North Sea, so already generating power, and they have a huge pipeline of growth for the next 10 years. So it's, as a utility, it has relatively stable sales and profits. It pays a good dividend here. They actually cut the dividend this year, which we were supportive of, because they're using that to invest in the future growth potential. So again, another example of a business that pays a good dividend now, not the highest, but because they are absolutely at the forefront of the energy transition, they're investing and have be able to grow that going forward. So not words you hear very often, but this is a very exciting utility company.
Well, we'll look forward to some returns then. So that concludes some stuff examples. I remind people to put questions into the chat room, and we'll get to them. I will just flick through some of the appendix slides. But we do have a question, David. Can you deploy gearing to the portfolio when you perceive the market as undervalued? And I think the answer is obviously yes, but if you can go through a bit about the gearing policy.
The answer is yes. We are, as the date of the presentation is put together, just over 12.5% geared. The limit at the moment is 15%, which is set by the board. That potentially could go higher, but we think that's a comfortable level. And we think about the gearing in two ways. There is firstly, is the market undervalued? And then there's, well, can we find companies that we think are good quality businesses that have high and or growing levels of income that make sense to the portfolio? So if we couldn't find great businesses, which frankly we always be able to in the UK, then we would not use the gearing just because the market's cheap. But we think the opportunities will always be there for us, and that's why we have the gearing at the level it is at the moment. We think there are some great opportunities, as we discussed already in the UK.
A couple of questions really on interest rates and inflation. We've had the inflation print out today. So if I can paraphrase, with regards to interest rates set to reduce, is this a catalyst for investors to reallocate to higher yielding equities, therefore driving up the capital value of the portfolio? And where does a yield get you before you start to sell? How low does a yield get before you start to sell? would you sell it on a yield only reason, or would there be a combination of the opportunity to grow the capital as well?
I mean, in most cases, if the yields come down, it's because the shares have gone up a lot, which is fantastic.
As long as the dividend isn't reduced. But
Yes.
yeah, exactly.
All else being equal.
Yeah.
And in that scenario, it would be about, well, what's the level of income now? How does that work with the portfolio as a whole in terms of what we deliver for our shareholders, but also with the share price having risen, what is the level of upside to those shares as well? So it's not just about the level of income, to answer the question, but it's part of it. And of course, we have just over 40 stocks at the moment. So it's the context of how that works in the portfolio. We have plenty of companies that we own that have yield well below the average, and we have some that are above. So it's how the portfolio is built up. But that's sort of how we think about it there. In terms of inflation and interest rates, I think that's a really fair point. If one thinks about it, you can get 5% income in a bank account. You can buy gilts, debt issued by the British government, that's going to yield well over 4 at the moment. So one might think that when those sources of income become less, the investors might look elsewhere, and income producing equities make a lot of sense. Personally, I think they always make a lot of sense, because you have businesses that can pay dividends now and grow into the future. But I think it's a really fair point. They should become relatively more attractive as we move forward.
Would you say that dividend policy by these companies in the portfolio, it would stop them increasing their dividend on the basis that if interest rates are lower and if they're paying 5-6%, there's no pressure from shareholders to pay any more? Do you feel there's dividend growth in the portfolio?
Absolutely. I mean, I can't think of a single company where we wouldn't expect the dividends to grow.
Okay.
Because apart from anything else, that's indicative of a good quality company. The ability to pay a dividend now, even some of the highest yielders, Legal & General, for example, yields I think almost 10% per year. But they confirmed in their Capital Markets Day last week they will grow that at 2% per year, whilst also doing share buybacks. So I still believe that companies who pay a dividend will see that grow going forward. Apart from the else, it's a really, really bad sign to cut a dividend.
Yeah.
And for any company to cut a dividend or even cut its dividend growth rate without really good reasons, i.e. SSE, big investment plan, makes sense, that's a really bad sign for companies. So I don't see it happening.
And share prices will react accordingly.
Yes.
Yeah.
I think the reason why dividend yields and income so attractive in the UK is because the UK market is so cheap, rather than they're paying out too much at this point in time.
And this leads us to another question. I mean, if the UK does remain cheap, M&A is clearly still a factor in the UK market, and we're seeing that a little bit in the mid to small caps. But is there any M&A activity in the bigger names as well?
Interesting enough, we own the portfolio Hargreaves Lansdown. Benefited from my point about if it makes sense to have turnover, we'll do. We bought it quite a lot last year when the share price was very weak, because that meant the dividend was very high. And we saw yesterday a new higher bid from private equity. We talked about it just now. So yes, there is a lot of M&A activity in the UK market, and it's getting bigger. I mean, Hargreaves Lansdown, I don't think it's in the FTSE anymore. I think it's just come out. It's not in the 100 largest shares, but it's still a pretty large company. So absolutely, overseas investors, whether that's businesses or private equity or other types of investors, are seeing the value in the UK market.
So good protection on the downside if we do get a little bit of a wobble on the macro side.
Absolutely, and that's what we're seeing. We're seeing businesses that maybe have problems either operationally or just from the backdrop, then seeing opportunistic bids.
Yeah. And finally, I think we'll finish on something that's obviously quite in the news at the moment, which is the election. It looks like a foregone conclusion, but we can't always guarantee these things. Is there any, or what impact is there going to be on the market and maybe the portfolio, or is it just too early to tell?
I mean, yes, I mentioned this a few times in the course of the presentation, that the election clears on in everyone's minds. I expect it to have actually very little impact in the near term. As you just said, it looks like a foregone conclusion. Investors have thought that for some considerable time. That the Labour Party have been pretty explicit about what they will do to some extent, but more explicit about what they won't do. So I believe they're very wary of a list trust moment. They do not want to come in and shock markets, particularly bond markets. The government borrows an awful lot of money and can't afford for the cost of that money to go up. So certainly in the sort of first 6 to 12 months, I don't see much happen, at least negatively. I think the turmoil we've had in UK politics over the last few years has been such that everyone is looking forward to actually a government with a decent majority that can act going forward with some consistency. And I think that actually will be a positive. And I mentioned earlier, we expect some changes to things like planning. Labour are very clear that housing output needs to increase. We need more houses. Also, of course, it's very good for employment. So I would expect, and perhaps I should say, I would hope that any impact, if anything, will be positive in the near term.
Okay, well, that concludes the questions and the update. If we can just ask David for some final words, some summary or conclusions before we pass back to Alessandro.
Yeah, thanks, Peter. I mean, I think my summary would be what I've said all the way along. I think CT UK High Income Trust, it is a unique vehicle in that we pay a high level of income. So as a shareholder, you can have almost 6% income. We believe strongly that we own companies that can grow over time. So you can buy the shares now and watch your income grow over the long run. We think that's really attractive, particularly the high starting level. And the ability to have gearing, which you've discussed, and invest a small part of our assets outside of the UK is something which also is very different and provides much more opportunity and optionality. And that, we think, makes this a really attractive vehicle for our shareholders.
Indeed. Well, thank you, David, and thank you, everybody, for listening.
Thank you for your time, everyone. Great for your question.
David, Peter, thank you very much for updating investors today. Could I please ask investors not to close this session, as you'll now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of CT UK High Income Trust PLC, we'd like to thank you for attending today's presentation, and good morning to you all.
Thank you.